Almost never before has a company so dominated the minds of people as Netflix. Not only did the company revolutionize the way we interact with media, but it's also produced some of the greatest entertainment in modern times. Today, I'm going to break down what makes Netflix so special and explore what's next for this media juggernaut. Hey everybody, and welcome back to Dollars and Cents, helping you make sense of making dollars. Netflix is a lot older than most people realize, founded initially in 1997 by Mark Randolph and Reed Hastings, who had come up with the idea while carpooling to work at Pure Software. Hastings had founded Pure Software and eventually sold the company. Using the money from the sale, Randolph and Hastings invested in the idea, creating Netflix. The founding of Netflix coincides with the creation of the very first CDs and DVDs in the US. This new way of viewing media proved invaluable to Netflix and its movie rental business. In the beginning, that's all the company really was. For about the first decade of its existence, a physical movie rental business. You pay for a movie, it gets shipped to you, you watch it, and then you ship it back. Using this business model, Netflix went public in 2002. However, the model began changing in 2007 when Netflix launched what would be one of the very first video-on-demand streaming services. Refining that service over the years, the company signed billion-dollar deals with movie companies to build up its library and internationally expand. By the end of the year, Netflix would post an impressive 7.5 million subscribers. By 2012, the company had amassed 30 million subscribers and released its very first original bit of programming, Lilyhammer. After this, Netflix really started to dominate the streaming world. Offered in over 100 countries in 2016, it had 100 million subscribers in 2017. Since releasing the award-winning show Black Mirror in 2019, the company has been on a roll ever since. But before we continue, I want to take a step back and look at the actual financials of Netflix. Revenue growth is first up, and it's no surprise that in 2016, Netflix reported $8.8 billion in revenue, which grew to an impressive $29.7 billion in 2021. Following that, we have shares outstanding. In 2016, it went from 428.8 million to 443 million by 2021. No surprise, honestly, there's not as much dilution as I thought, which is nice. Next is free cash flow, and what a wild ride. In 2016, Netflix reported a negative $1.6 billion in free cash flow. It continued to lose more and more money every year up until 2020, reporting a positive $1.9 billion. However, as of the most recent year, free cash flow went negative again, this time losing $132 million. Now let's compare Netflix's last 3 years of EBITDA to its net debt. First, Netflix averaged $15.52 billion in EBITDA over those 3 years. Comparing this to the net debt of $20.67 billion, we discover it's only 1.3 times the company's EBITDA average. That's really good because it shows that Netflix is capable of bringing in enough money to pay off its debts. Normally for this part, we would compare Netflix's free cash flow to its market cap. Unfortunately, given the fact that the company hasn't had positive free cash flow over the last 5 years, we can't get an expected market cap. In the same vein, we also see a negative return on invested capital in the last year and as an average over the last 5 years. Given that lack of free cash flow, we'll instead look at return on equity and price to book value. Netflix's ROE stands at 35.3% over the last year, and despite the recent fall in share price, Netflix still trades at a fairly rich 11.12 price to book value. Overall, I think Netflix's balance sheet is really good. Granted, there isn't much in terms of free cash flow, but I think that's by design. Otherwise, Netflix can easily afford its debt and is rapidly growing its assets and value per share. And beyond financials, we should look at the bigger picture, the large exodus from traditional cable media to streaming services. Netflix undoubtedly has spearheaded this trend and led the way. Other companies only jumped on the wagon far later in the game. Essentially, that means Netflix has had a tremendous lead over its competitors, and this is borne out in the fact that they have over 100 million more subscribers compared to Disney Plus, which is number 2. Yet despite the many deals Netflix made with larger media companies, the introduction of new competitors in recent years has forced the streaming giant to get creative. Netflix had to produce its own original series, and it came out swinging. Shows like Arcane, Stranger Things, Ozark, and The Witcher are just a few of the smash hits Netflix has produced. And as long as Netflix can keep up producing these blockbuster shows, it will remain on top of the streaming wars. Plus, Netflix has been able to leverage these amazing shows and its massive catalog in one very important way: customer retention or churn. If we compare Netflix to the other major streaming services, we can see a massive difference. It has a churn rate of only 2.5% monthly. This puts the company way ahead of Disney Plus at 4.3% and HBO Max at 6.7%. I imagine most of this low churn rate can be attributed to its deep content coffers and the carefully crafted recommendation algorithm Netflix has spent years perfecting. There's an incredible amount of variety and content sourced from around the globe. There's just about something for everyone. Another note to hit on is the large financial institutions and their relationship to Netflix. More specifically, Bill Ackman and his large bet on the streaming giant. While it's true that institutions can and have been wrong about companies in the past, it's hard to not be impressed by the numbers. We'll use this great website, Whale Wisdom, to look at some of the stats. Of all hedge funds and money managers, 65% more now place Netflix in their top 10 holdings as opposed to last quarter. 15% more started new positions and 25% less closed their positions. As well, call options are bought a lot more than puts on Netflix. In themselves, these numbers don't really mean much, sure, but it's certainly interesting. Just to add to the fact that one of Netflix CEOs, Reed Hastings, also just bought $20 million worth of shares after the recent dip. While this is all positive momentum for the company, Netflix has some drags pulling it back. Drags like these can grow into formidable obstacles, so let's dive in. The first and largest is, of course, competition. Let's face it, Netflix hasn't really had a major competitor in the streaming space until very recently. While the streaming giant has been able to fend off these competitors, it looks like the tables are turning quickly, and the biggest problem, I believe, has to be the new Warner Discovery deal. I think many investors and people in general underestimate the magnitude of this deal. Now that Warner is no longer bogged down by AT&T's business, it can shift wholly onto content. Warner Discovery still has a lot to prove, but I also think that no one should underestimate it. The new company could very well grow into a major player in the streaming space in no time at all. It could very well be a dark horse in the making. In general, the increase of competition has had some very obvious effects too. According to a report from Ampere, Netflix has lost 30% of its market share to competitors in 2020 alone. Of course, this isn't necessarily Netflix's fault. It still holds the #1 spot, however that loss is still concerning nonetheless. Yet one of the biggest concerns I have is the company's inability to generate meaningful free cash flow. Just look at this. That's pretty bad. The only reason Netflix even generated free cash flow in 2020 was due to the fact that it basically couldn't spend money on making new shows. I believe this lack of profitability will severely hurt the streaming giant. Basically, that tells me Netflix needs to go even deeper down the hole of unprofitability to fend off its competition. If we look at some of the surrounding companies, again, we see something interesting. They're all free cash flow positive. Disney, Warner, and Apple all generate massive amounts of free cash flow. It allows these competitors to produce content, sometimes even at a loss, because the rest of the business more than makes up for it. Netflix, however, does not have this luxury. Its only revenue stream is paid subscriptions, which means it has to produce blockbuster shows and draw in millions of more subs. That's the only way it can maintain this cash burn. With content spending jumping 26% from 2020 and 18% from 2019, licensing fees also continuing to rise 30 to 50% over the last 5 years, we see a potential problem. If Netflix is unable to continue growing revenue by high double digits and, more importantly, faster than it increases spending on content production, the company will find itself in boiling hot water very quickly. Even though its most recent earnings call wasn't that bad, it tells an uncertain story about Netflix's future growth. At the end of the day, one of the most important aspects of any business is the ability to generate a profit. Those that don't won't stay in business for very long. Unfortunately, that's my biggest concern for Netflix, the uncertainty of profitability. So that raises the question, am I buying Netflix? And the answer is an easy no. I don't personally watch Netflix, but I can see how the company's platform content is compelling. I can see how the company built up such a loyal subscriber base. It offers good stuff, domestic and internationally. That said, unprofitability and increasing competition are the major drawdowns for me. That's why I'll stay away for now. That said, that's all I've got for you in this video. Leave your thoughts on the streaming giant in the comments section below, or hop on my Discord where we can talk more. Until next time, I'll see all of you in the next episode of Dollars and Cents.